Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Wherever you're tuning in to the podcast today, it's that time when we get together and we talk about money, and we all know that money or your ability to access debt and manage your finances is critical as a property investor to grow your portfolio and manufacture wealth, whatever you choose to do with that wealth. You might be going on cruises or buying supercars or, just changing the way you live. All up to you what you get to do. You get to make that choice with the money that you manufacture. Our role here is to sort of help you maybe shape and rethink how you're going about things, how you can ensure what you're doing today is going to get the best outcome, whatever that is for you at that point in time when you want to perhaps work less or maybe work more and do more with your money. Completely up to you. But in the studio joining me, Eva Loisance, who is the head broker, principal of Finni Mortgages. She's back to help us out with a lot of stuff. Again, a lot of good feedback, Eva, around your insights in the money. People like the way you're doing it.
Hopefully.
Thank you.
Yeah.
That's good.
Yeah, that's good.
That's good.
Good
That's
to
really
hear.
good. Do you have any people call up from the show saying, hey, I heard you on the Smart Property Investment Show.
Yeah.
Can you hook me up with a home loan?
Yeah.
Or a mortgage?
That's a lot of our new clients. Yeah.
Is it really? Do they say, I've been tuning in for ages and I thought I'd finally call you? I just listened to it and I realised that you're the broker for me.
Yeah, a bit of both, and also clients that told me someone else has put them on the show because they thought, or they hear podcasts, and like the family pledge we did a few weeks back as
Yeah?
yeah,
Like
has
kids
already-
calling up
yeah,
saying, I
got
listened
a
to
few.
it.
And
Yeah.
parents.
So parents going up, I heard it.
Yeah, I
'cause
didn't know how to help my kids, and
That's cool. I think that was sort of where I positioned it, saying, hey, for all you investors out there who have kids who are
yeah.
saying it's unaffordable, and you see it all the time, there are ways into it. And I'm very conscious that the audience we have for this podcast are all dialed into the idea of trying to manufacture wealth through using property as an investment vehicle, and therefore have already sort of gone through that process of challenging and thinking about it. Some of the commentary I would come up on with this, a lot of people would think, oh, he doesn't know what he's talking about. He's out of touch. He doesn't know how hard it actually is out there. Yes, it's all nice for you rich property investors to be able to talk that way, et cetera, et cetera. So I do acknowledge that it's tough out there. I do acknowledge that, it's always a challenge, always has been generationally to enter the property market. Today, is it as hard as what it has been in the past? Maybe it's harder. You speak to some people, they say, no, it's the easiest. It's the easiest ever for kids to get into the property market because of things like family pledges. So there are ways around it. And it also, I do cop a little bit of criticism here and there where I'll say, property's affordable. You can buy today I've just settled on a property in Mount Druitt that I was selling. It was like $320,000 or something like that. We sold this 2-bedroom apartment.
Affordable.
Stone's throw from Westfield, walking distance to the station in Mount Druitt. And, a lot of people will say, well, that's nice, Phil. Well, I don't want to live in Mount Druitt. I want to live here or there or wherever it is. It's irrelevant. They go, but it's affordable. It's affordable.
Yep.
So affordability is a state of mind. And you get to make that choice around it. But to your family pledge thing, it's good that people caught up. Really good.
That was good. Just turns out people don't know about it.
They just don't know about it.
They just don't know about it.
So that's what we're going to try and talk to today. And I apologise in advance to everyone if we get a bit basic today and we're able to sort of jump around and move on this show. So if all of this is like, yeah, I know it, like this is 101 stuff for property investors, that's fine. I'm sure you can go and find another episode to listen to, which is a little bit more strategic than what this one will be, or strategic, or maybe a bit more sophisticated is a better word from it. But I actually hosted a roundtable the other day with Arjun Paliwell, who you would know, and most people on the show would have heard of. He sort of heads up InvestorKit. And one of the questions was asked at this roundtable. We sort of had a dinner with like 12 or 13 property investors, and I want to ask you the same question. It was a sensible question in that one of the guests said, okay, I get it. I'm talking about sort of sophisticated stuff and more basic stuff, right? But he sort of went, I I get all this stuff. That's really good. That sounds all. That's pretty standard stuff, right? What we're talking about is pretty standard stuff. I want you to tell me about the stuff that no one knows about. And Arjun had a response, and he sort of, went down to some really detailed type strategies around trust-based lending and balancing and managing stuff. And this gentleman said, that's good, but like there's got to be something else which is real, like just no one knows about. And I sort of jumped in and went, property investment is pretty simple. My view of it all is that property investment is pretty simple, and you get more sophisticated things, right? Or you learn new things, but there's no real secrets in property investment. And my point was, anyone that has some super secret that no one else knows about, and the only way you're going to unlock that secret from them is to spend this money to do this, that, and the other. I went, there's no secrets in property investment. And if there's a secret that's so good that you got to pay all this money for it, I'm going to say it's probably on the shades of risk that you might not want to be operating within, or so far outside of the norm or whatever. So the best operators I know in the market, yourself included, Eva, they give this information away. There's no real secrets with it because it's pretty basic, right? Secure debt, buy good properties, and over time it'll grow in value.
It is very basic, but people misunderstand a lot of it.
They misunderstand a lot of it. One of those is
make mistakes, and that's why we keep, I guess, sometimes repeating what we're saying about cross-collateralization and offset and debt recycling we're going to get into today. And all these things, it seems very easy. And even sometimes people that have 2-3 properties still don't know how to check how much equity they have, or they're giving me random numbers that don't make sense. I'm like, how did you get to that? So
we're going to get basic today. But it's sort of basic, but it's not.
It's basic, but it's not, because I think a lot of the mistakes, or a lot of people are just standing by because they don't know what's possible with their situation, and also make mistakes just checking numbers.
Yeah.
But yeah, it is simple. There's no secret.
There is no secrets. So there's no secrets here on the Smart Property Investment Show. That's the way we like to do it. So we're going to talk about debt recycling. So essentially this is the process of accessing and leveraging the equity that you currently have
in your property.
And we can talk, and while I'm saying this is a little bit more less sophisticated strategy, we're probably talking more to people who may be very new to investing, or they've got a principal place of residence, and they're now at that point in time they're going, what's next? I want to do something. So we're going to sort of frame the chat today around it. So let's talk about accessing equity. And once we sort of understand what the equity is and how you access it, we can talk about the concepts of debt recycling and some of the sort of intricacies of that. And we've sort of got 10 points here, and I like to shape sort of discussions with that, because it gives us a bit of a scaffold for going through it. But the way I'm going to do it is I'm going to start it after we have a break. Just a couple of short messages here, and when we come back, we'll get stuck into it back in a moment. Welcome back, Phil Tarrant, host of the Smart Property Investment Show with Eva Loisance, which I still say your name really, really fast, so it sounds French, principal at Finni Mortgages. As we enter the new financial year, your team sort of just going nuts. Everyone's sort of calling up.
Yeah, quite excited about the new financial year. We've got big plans, so I think everyone's quite pumped.
Tell me about the last day of the financial year. Last year was much. Is it like a big day for mortgage brokers?
Yeah, it was still a big day. Yeah. Monday to settle everything we had to settle.
Today's Thursday, and that was the Monday, right?
It was Monday, yeah.
So everyone's scrambling, wanting to get stuff done.
Yeah, I think we had a lot of buyers agent that we work with trying to settle properties before the end of financial year.
Okay.
So we had lots.
I wonder how buyers. I'm going to get technical for a moment about accounting. I wonder when buyers agents recognise the fee that they receive.
Settled, yeah.
Do you reckon when the date of settlement is probably when they recognise it in their accrued financials? So they're probably all sitting there going,
totally. Otherwise, why would that make sense?
That's the only thing I can really
see.
They don't
care.
Yeah.
For buyer's perspective, for seller's perspective, maybe they want to get rid of it for the next financial year, for tax return, whatever.
But it's when you sign a contract rather than when it settles is when it's considered for. And I spoke about that probably just before the break. It settled today, which is three or 4 days into the financial year. However, because the exchange date is the contract date, and therefore that's when it falls into the tax year. So it And this is where
that's true.
this is when you start sort of doing this sort of stuff. You got to work with the accountant on it. But it's the only reason why I can imagine.
Maybe,
That must be when they recognise they accrue the
because until it's settled,
revenue.
it can fall apart.
Yeah, but a settlement is when they do it. So
I'd
they're
say
probably
so.
sitting there thinking that if I can accrue the income here, because a good accountant will do things appropriately, accrue the income here, that means I'm going to make more profit, and therefore I could probably borrow more money to buy more property.
More properties.
I reckon that's what they'll be accessing equity, no doubt.
We had a record months last month.
Oh, did you? That's pretty cool. How do you guys celebrate like record months? Do you just sit there and go, oh, thank God that's over. I'm going to go and
just have
lie
a
under a
nap.
doona and have a sleep. Anyway, here to talk about accessing equity. So where do you got to start with that? Imagine, so let's just explain what equity is first.
Yeah. So in simple way, it would be the difference between the value of your property and the debt you have against the property. Very simple. It's your property worth $1 million, you've got debt 500, equity is 500. It doesn't mean you can use 500 with the bank.
No, but that's how much equity
You've
have.
got.
And we're going to talk about how you actually
Access
leverage
it.
that equity.
Yeah.
So that would be, and again, back to your high school economics, assets and liabilities, you have things. An asset would be a property, and a liability would be the mortgage against that. So what you generally want is your assets outweigh your liabilities, and if you do that, you're in the black. If your liabilities outweigh your assets,
you would hope
you're
doesn't
in the red.
happen too often.
No. So you want a lot more assets and a lot less liabilities. So the house is an asset, the debt is a liability. So what you're talking about there is the gap between what's left after you take the liabilities away from the asset, and for the purpose of property investing, that's equity.
Yeah, and when I saw about doing this podcast, I was really thinking about people probably more in the traditional way of doing things, buy my house, pay it off, and then I'm 45, 50 and I realize I'm not going to have enough.
How many people got their house paid off at 45, 50?
No, but like bought this with that thinking, right?
Yeah.
That they won't have enough when they retire. So we get a lot of clients in that age bracket, let's say 50s, that just come and say, oh, what can I do? I don't really have much cash, or maybe 100, 200K there sitting in the offset. I don't know what to do with it. I don't really want to invest with that money. I just rather have it, like quite traditional in that way. What can they do? And then they realize they can use equity in their home.
Yeah. See, I sit there and a family member of mine, she goes, all my debt's offset. I go, oh, what are you doing? She goes, but I'd just like to know that the money is there.
Yes.
And I go, I sort of get it. Like, I understand it.
Could be under the mattress.
Could be on the mattress. Same for a rainy day. And to be like, if you're offsetting your debt, you say you're getting 6.6% on your money, right? Because you're not paying the interest on it. So it's better than a term deposit. It's better than a savings account. But the idea being is that you can deploy that.
But she probably
elsewhere.
has lots of equity in the property.
Oh, it's got heaps. Yeah. She's got, but it's just offsetting everything else. And but again, it gets to a point where maybe your serviceability doesn't allow you to borrow, or you're at a particular age.
If you buy investment property, even if you are, let's say, retired and you don't have any income, you still have the rent coming as income that can be used. And there's still lenders that would look at that. Yeah,
which is good. So we know what equity is now. So the process of accessing your equity, you need to get a valuation. Okay, so how's that work?
So we can do this with your current bank or a different bank. There might be an opportunity to review your rates, make sure you are on the best deal that's that's suitable to your circumstances. We do evaluation. We just make sure exactly how much equity is available, and then we can use up to 80% of that equity without lender's mortgage insurance. Yeah. So people that have bought properties 3, 4, 5, 10 years ago often have hundreds of thousands sitting there that they could use to invest.
So for simplicity, we're going to use people with a principal place of residence who have never invested before. And that's a lot of most people, right? And the numbers are out from the recent ABS stats, and it's still the biggest cohort of investors only have 1 or 2 properties, right? So most people, this is where they'll start and where they'll probably finish is that the principal place of residence, that has grown significantly in value. So let's use as an example, $1 million house with 4... what's a really easy number for us to use? $1 million house with, let's say they've paid off. So they've got
500K.
500K, right? 500K of equity in there.
Yeah.
So
Or 500K debts. They would have,
Sorry, yeah,
at 80%, they would have 300.
300. So you got 300K.
Yeah.
You can take
Yeah.
80% of that money out.
Yeah.
How much would that be?
So if the property is 1 million, the debt is 500, equity is 500, 80% of that 400.
Yeah.
Yeah.
So you can take $400,000 out.
Yeah.
Yeah. That's crazy, right?
Yeah.
A lot of people say, so, well, really? I get access to $400,000.
So it's a loan,
Yeah.
right? It's not here's some cash.
Yeah.
It's a loan. And that is misunderstood a lot as well.
What do you mean?
People think the bank's going to give you cash in advance.
Well, they're just going to give you the money.
Yeah, and then you just
Without-
refund it when you sell the house. No, it's not like that. It's a loan.
Yeah.
Yeah.
Yeah. Yeah. So then you've got that money, $400,000.
That you would use as a deposit plus cost plus your buyer's agent fee plus whatever it is to buy the investment property.
Okay. So I think that's pretty simple. Where it starts getting a bit more complicated is, say, someone will say, but I've got
300 in the offset that
in
I
the
can
offset
use.
account that I can use. So I've got access to $300,000. It's in my offset. That means it's there and I'm comfortable.
Yeah,
it's there,
why
it's
would
a
I take
buffer.
on more debt?
But why would I take on more debt?
Yeah.
And you can say, oh, that's fine. So because you've got your mortgage offset by $300,000, you will still be paying probably a P&I, which means you're paying off your home
So,
faster. And a lot of people would say that's the right thing to do. What we're talking about is saying, no, don't do that. Actually, pay off that loan,
Or reduce the limit.
but
of
reduce
the
the limit, and then refinance the lot. So by doing that, that means you can
More
still get
tax-
access to that money, but it's a lot more tax effective.
Yeah, same amount of debt, same amount of. I guess you would lose part of the cash because the loan has been reduced, but you would get that cash back as an investment loan that would then be tax deductible. And it doesn't matter if it's against your home; it's the
Yeah.
purpose of those funds that make it tax deductible or not.
So you've leveraged your equity from your home and you've turned it from non-tax deductible debt into tax deductible debt, and hasn't changed where you live or anything like it. Your repayments have changed probably a bit, but okay. So this is really easy to draw out on a whiteboard and show people visually. It's
Yep,
probably a little
yeah.
ble bit harder to paint a verbal picture. So let's just do that again.
Picture.
All right, a verbal picture. Okay,
So
I want you to
we've
do a
got the
verbal
million dollar house. I'm just going to make it in $1 million house. $500,000 loan, offset 300. We're going to put the 300, or let's say 200. That's all you need really to invest.
Mm.
We're going to put $200,000 worth of the offset money into the principal place of residence loan. So 500 minus 200, the loan would be reduced to 300. We're going to get that 200K out again as a new split, investment split. So the debt is still 500, but 200 of that being recycled into an investment debt, tax deductible, which means you can claim against your income. You get some money back.
Okay, so you've just turned savings, which is in your offset, into tax deductible debt.
Yeah, investment.
Yeah, tax deductible investment debt.
So, you see, you've got 7 of debt, 500,
Yeah.
and now you've got 200 there that you
So
can.
your net position is the same in terms of
Yep.
the equity position. However, your repayments would have gone up because
Not necessarily. The interest rate might be a bit higher if it's an investment debt,
Yeah.
but you would go on interest only,
yeah.
so might not be.
Okay, so
Might not be.
this sounds. A lot of people might go, "Well, I still don't get it." Like, do people call you up and
Yeah,
ask you to
we
explain
have
it
to
all the
explain
time?
that all the time. Yeah.
Yeah,
So I want to talk about it today because it's if you don't do that and you go and spend the $200,000 you got in your offset for investment property, not only, well, you used to pay interest on 200 on your loan, now you're going to pay interest on 500 or whatever you spend from the offset. So you pay more interest that is non-tax deductible and you got less debt.
it just sounds. A lot of people think it's counterintuitive to turn savings in an offset into a liability that you have to pay.
Yeah, but I'm
You
not
need to
increasing
pay-
the amount of debt, right? It stays at 500.
The debt stays the same, right?
Yeah.
And you're turning cash into tax deductible
Yeah.
investment debt. Like a lot of people just go, why would
Yeah.
you do it?
Yeah.
Why would you do it?
I think when you put the numbers black and white on paper,
Yeah.
and they're like, oh yeah, I can see
gotta
it
see it.
now. You know, it's the amount of debt, and half of it, or more than 200K in this example, I can deduct. If you're a high income earner, it's 47
Yeah.
cents a dollar. That's it.
Yeah, and obviously speak to the crew over at Finni or Eva over at Finni for this info, but also your accountant should be able to work you through this sort of stuff as well, like because there's going to be consequences.
Yeah, but
around
very
it.
often people go and invest the money, before they go to do the tax return.
Yeah.
Right?
Yeah.
Yeah.
So there would be tax benefits through doing this.
Yeah, and obviously I can't advise on
No.
tax or anything, but if you just look at the numbers in a very simple way,
Yeah.
it makes sense.
See,
And that can be anyone can look at it online. It's called debt recycling.
yeah.
It's a very known process, very much underutilized.
Yeah. Yeah. So a lot of people, if you watch the social media, would be like, hey, we've uncovered this way to do this. Here is a hack.
The secret.
Here's a hack. Here's a secret. ... Like this is how finance works in property investing.
Yeah.
You know, and banks, like this is not some secret. This is not
it's not,
some.
but
It's not a workaround. It's not a hack. It's just
no.
This is
It's
how
the
you
way.
do it.
This
This
is
is the
the
way to do
way.
it. So banks are. This is day-to-day business for them doing this sort of stuff.
Yeah.
And
So
they encourage this sort of work, right?
Yeah, so I guess the real time you have to save money is to buy your first property.
Yeah.
Or not even if you get a family place, right?
True.
But then you don't have to ever save ever again to keep buying properties. You can just use the equity.
So we did this on the Smart Property Investment portfolio, sort of when we started building it out. We started, I think that portfolio, which at its peak had 17 or 18 properties in the portfolio, which I never really thought was that big, but you know, in hindsight, it was probably a pretty big portfolio. Put perspective into it, and the initial cash we put into that to build that portfolio was $200,000. So the initial $200K went into it, and we sort of bought a couple of places pretty quickly, sort of 2 or 3. Did renos, all that sort of stuff. Total cash in, as in like money we had to put in, $200,000 or thereabout. And we built that portfolio out just by doing exactly what you spoke about. So we didn't start with a principal place of residence to draw the cash out of. We actually had the cash to put in. But then subsequent to that, the same process. Just build, grow the equity, extract the equity, deploy into another place, extract the equity, deploy to it. And some of those properties we refinanced like maybe 2 or 3 times, right? In the western suburbs of Sydney way back when. And then when it got to the point where we refinance, because you keep refinancing, you grow in your portfolio, stuff's going up in value, you're making more money, that sort of stuff. We took the $200,000 back. We took it out, and we just went, okay, job done. It's like going to the pokies, right? You make enough to get your original sort of bit, and probably investing isn't like pokies, but
Hope not.
but we took the money out. So that portfolio, of which still exists today, it's a bit smaller than what it was at its peak in terms of the number of properties, but it's a free portfolio, like in terms of capital. So you talk about cash on cash return, which people talk a lot about in property investment. Well, it's infinite. There is no cash on cash return. It's all, people go, that's not how it works. You show them and you go, okay, that's the reason why we built it out. But that's just by doing debt recycling.
Yep.
Okay, so let's talk a little bit more about that. I think we've done a pretty reasonable job trying to explain this verbally. Again, if it doesn't make sense, get in touch with the crew over at finni.com.au. They can help you out. But some nuances around it. We'll just go another break. Stay with us. Back in a moment. Welcome back, Phil Tarrant, chatting with Eva, principal over at Finni Mortgages. Now, you spoke very quickly about this. There's no LMI on this sort of stuff, so lenders mortgage insurance if you do it this way.
Look, most people would have enough equity in their home that we don't need to go over 80. But if, investors sometimes really aggressive, want to get in the next property, they would go again at 90%. They would extract equity at 90%, buy the next property at 90%.
So a lot of people redline and go hard, just to do it. But then you get to a point where this will accelerate your accumulation period, but then you can refinance a lot back to 80% once the equity's there. And don't pull the cash out. Just refinance, get a cheaper rate. But you've already paid. If you've already paid the LMI.
LMI is non-refundable. It's paid. It's gone.
So you just go, it's no time, don't worry about it. You do it once, you pay the premium. So you're paying premium to access more capital.
And look, LMI it's fine. Sometimes you pay, I don't know, 10 grand for property that 500,000. That property grows, 5% per year for the next 5 years.
But it's capitalised though also.
Yeah.
So capitalised, just explain that quickly.
Capitalised means you don't actually pay the fee up front. It goes on top of the loan. So you're going to pay interest on that too.
Yeah. So again, it's a price to play.
Yeah. Tax deductible.
Tax deductible. But, okay, so there'd be another aspect on this around sort of cash flow and buffer sort of planning stress testing. So you don't want to go... A lot of people would have money sitting in their offset because they like the idea of
Buffers.
a rainy day and a buffer. So you probably still need to have an appreciation for where your buffer level is.
Yep, that's right. So often, people with money in the offset or redraw, there is this, and I think it's a good buffer of people saying, I need 6 months of my living expenses in my offset.
How many people do you know that got 6 months living expenses?
People that have 200K in the offset, that's probably how they got there.
Yeah, okay. Fair enough.
Not many.
No. It's just living expenses. It's a cost of living crisis, you know.
Yeah.
But again, it depends on what you do for a living, what sort of buffer you need.
That's
right. If you're PAYG versus self-employed,
that's right.
If something happens to you, what's your insurance situation like, all this sort of stuff.
But there's scary studies that shows that people don't have enough to buy a new fridge if it breaks tomorrow. Which is
crazy.
Yeah, it's a bit scary.
Wow.
So, yes, if you do have 200K in your offset,
buy a fridge.
you can buy a fridge.
Yeah, ice, $3, three bags, $10.
Yeah.
Do you know how much a loaf of bread is these days?
Yes, I'd still do shopping. Yeah.
It's so funny that question.
Do you?
Well, it depends where you buy it. It's my question. You go to Baker's Delight, $3.90, $4 depending. If you get poppy seeds, a little bit more.
Yeah, if you go to market and it's sourdough organic.
Go to some of the bakeries I go to, $15 for a loaf of bread. Like you just go, no, well, I can't do it.
Yeah.
I'm that guy. You can still go to a good bread shop out in the burbs and you get like a loaf that maybe a day past. You still get $1.50. It's good for toast.
If it's a good bread, it will last a week. That's what the French say.
It's good bread to last a week, right?
Yeah.
But what's your system for making bread that's a bit dodgy better? Like, would you put a baguette in you toast it?
And then we've got that thing, I'm sure you've heard, called pain perdu, which is lost bread. When bread is really past.
Right, hang on a sec. What's it called?
Lost.
No, in French.
Pain perdu.
Pain perdu.
Perdu means it's lost, it's gone.
You call it lost bread?
Lost bread.
Brilliant.
So the technique is you put it in milk, so it will get all soft again. Cover it in egg, sugar, and then put it in a pan with butter.
Okay, like French toast.
I guess so.
Sort of. Lost bread.
Yeah, so that comes from basically bread that was really past.
Like how bad?
Like hard, like brick.
How often, and this is the Smart Property Investment Show, how often would a French person throw a baguette out? Like never. You'd always find a way to use it.
I would be eaten too quick anyway.
Too quick, yeah. What about sort of defrosting? So if I don't get through my baguettes, I'll put it in the freezer.
No, don't put
That's bad.
Sacrilege.
You can't do that, right?
I can't do that.
We had a blackout just the last couple of days, and I think it's probably all gone. So so don't freeze bread. What about would you freeze like a slice so you can put it in the toaster? And no, that's bad. But at least in France, you just walk out the door and there's a bread shop. Yeah. Anyway.
So note.
But these are the detail you need, like lost bread.
That's how you have money to invest. You do not waste anything.
Yeah. So let's just talk about this concept of turning the equity in your principal place of residence into tax-deductible debt for investment purposes. So that bit you take out and you use it to buy an investment property as the deposit for it. It still sits as a split loan on the principal place of residence, but it's hived out. You've got a different reporting line, different
so it's a new split, new loan. So behind the scene, it's attached against your PPOR, your home. But it's really, you wouldn't know. Like, it's just a loan, it's an investment loan, and you know that loan is for.
So you have two loans. You have two loans on your different loan numbers.
Different numbers, yeah.
Same lender, obviously. So different loan numbers, and you know that bit of money there was used to pay for the deposit on this property over here. So on the investment property, essentially, it's got two loans against it.
Not against it.
No.
2 loans for it.
Two loans for it, but not against it.
Yeah.
So the loan used for the deposit is a liability against the principal place of residence. So if you had to sell and or you were foreclosed over here or whatever happened there, that loan is a liability against that place.
Yep.
But it's not incumbent on the investment property over here. So there's no way they could come over to your investment property and say, you need to pay this loan back because it's been used for that, because it's connected.
It's separate, yeah.
Yeah.
And that's where it's dangerous to cross-collateralize.
Correct. So this is the point. So you can have, so the loan you use to raise the deposit on the first investment property can be with a certain bank, and then once that money is pulled out, it's irrelevant. But the bank typically will say, what are you going to do with that money?
Future investment.
Yeah. So you can't say, I'm going to buy a car. But they might not, because then they might limit how much you take.
Actually, a funny one. Last week, I had the bank asking me to confirm in writing, or the client to confirm in writing, that the money was not to be used in cryptocurrency.
So they didn't want people to take money out of their principal place residence and put in crypto, which I'm sure people are doing now.
Yeah, but in writing, that's always interesting.
I was chatting with some mortgage folk the other day, and they're now talking about lenders in America are now saying that they're now viewing crypto as an asset for the purpose of borrowing money, whereas not doing that here in Australia yet.
What, to borrow against crypto?
I think as a measure or assessment of someone's wealth and
yeah, we do put it in the assets. I don't think they would not make a decision based on that.
Okay, so you got your money from your principal place of residence. There's different loans. You chuck it in and then get another finance here. So often people would use the same lender for doing that, or for simplicity.
Sometimes yes, sometimes you have a property, let's say your home, with a lender. It's just enough to get the equity out, but you don't have enough servicing capacity with that same bank to keep going. So we go and do the investment on somewhere else.
Okay, and you don't need to deploy that money straight away. So you could pull that money out and just put it in your offset.
Yeah, put it in offset again.
So then you're still at the same position where you're paying the same amount of interest that what you would have had if you didn't
do that.
If you didn't do that, and that can sit there for as long as you want.
Yeah, so generally we do interest only 5 years. So 5 years it's a long time to go and buy a property.
Yeah, it is, but it means it can sit there, and if you want your confidence level, you can wait for the right time, and then you can deploy as you need. So people talk about that sort of, I guess, it's dry powder, right? It means that when you're ready to go, you can action. Have money sitting in offsets, and a lot of investors, what they do, and I don't necessarily do this myself. I'm going to maybe do a little bit more on some assets, where they constantly refinance at 80%. Like whenever they get a chance, they're always just testing evaluation, testing.
Cash ready to go. Cash,
and then they'll just, every chance they get, they'll just refinance, and just have it in offsets. Keep refinancing, sit in offsets, and then they can go bang, bang, bang when they need to. You must get a bit of that.
Yeah, sometimes there's not much of equity in each asset, so we have to go 30k here, 40k there, 30k here. All combined, it's enough to go and buy another
That must
property.
be a nuisance to.
Sometimes it's annoying,
Yeah.
it is.
Is it even worth? Like, when is it worth your while to actually refinance to get? Like, you're not going to be going through.
You wouldn't refinance. Like if the bank has a good enough valuation, you just do a top up for 30k or whatever it is.
Okay, so that's different. So that'll be a different loan. So 2 loans on the one property.
Yeah.
So you go back to your bank and say it's gone up in value by $50,000.
I just want a 30k extra on the loan.
So same security, they'll put another loan on it, so they'll have 2 loans on one property.
You can choose. You can either increase the loan you have, or a new split if it's for another investment property.
Okay, so that's when you have investment properties rather than principal place residence.
Yeah, you do not want to mix up non-tax-deductible debt and tax.
Yeah, I guess it's a nightmare for your accountant. Your accountant's always going to ask you this anyway. So, okay, so it means you've got a new place, new investment property, it's tax-deductible debt. How often would you recommend doing it? Every 6 months, doing a review of your portfolio just to extract equity to debt recycle?
Yeah, 6 months.
Yeah, a year, yeah.
I guess it also depends on your capacity. Like some people they stop because they don't have any more borrowing capacity. So there's no point refinancing, trying to access equity that you can't service anymore.
Yeah. Because every time you access it,
it's extra lending to. So
every time you access it, you put an offset, you're not going to pay anymore. As soon as you deploy it, you're going to start paying interest on it. So again, it's a serviceability. The more you do it, the more it reduces your serviceability. You've got to get it right all the way through.
And it's breaking that ceiling that's hard, right?
But for a mortgage broker then, like a lot of mortgage brokers would just go, like, talk frankly, it's just not worth your while doing it. Like, because I guess mortgage brokers are paid a commission on the loan, like,
Well, definitely not worth it to just do a top up for
20,000
30K for
or
someone.
30,000.
Yeah, but
Yeah.
if you look at refinancing, doing the cash out, buying the investment property, second investment property, it's a whole journey, right? We just don't get clients for one top up. It's a whole.
So the point then is you're starting to access more sophisticated property investment type. I know Finni specialises in this, but this is when you've got to start getting really strategic. So you guys are putting a lot of time into doing these things, right? You know, and the same amount of time would go into refinancing a place to extract $100,000 and a new loan for $2 million. Same amount of time.
Same work, yeah.
But you get paid very, very differently.
Yeah.
Do you guys ever think about going, you know, if like to actually get this level of service, you know, it's high ticket stuff, you know. Anyway, so you need a pretty good audit trail with this, right? You need everything separated. You need to know what's gone where, because your accountant will go.
Yeah, you need to separate every time you do it again. I guess new splits, so it's very clear where the money was sent and what for. Yeah.
So I'll conclude with this question because I'm conscious of time, Eva. If I do this and my principal owes residence, I do what we've just spoken about, put the money into it, refinance a lot, pull the money out for personal tax. Do I have to buy property to that? Like obviously crypto might make banks a bit nervous, but
well, technically once the money is out,
that's yours. Yeah. But you can buy ETFs or shares.
Yeah, and that's acceptable purpose as well. Like there's no I guess limitation. Once it's out, it's out. It's just I guess for yourself to know. Well, this was for investing. This was to build wealth, and I bought a new car. And
that's it, right? That's when you're turning an asset into a liability, right? The cash you have as an asset.
Yeah.
If you deploy it into something which isn't going to be, and this is not investment advice at all, as a disclaimer, but if you're going to put it into something which might be on the riskier side of investing, and you know, I'm sure you could throw crypto into that or some other things. That the point is that if that money fritters away and you lose that money, you're still reliable to pay the debt on that money. So even that money can disappear, but over here, the lender's going, mate, there's 200 grand I gave you. You need to continue to pay the interest on that. And you go, I don't have the 200 anymore. It's gone. So you haven't turned that you've turned that into a liability, and the liability becomes nothing or much. So you could be paying, the mortgage on something which is only worth 50 grand. So the idea is that you want to put it into another income producing asset.
Yeah.
Right. It's what they should be teaching kids at school.
Oh, please, yeah.
Rather than pulling that money out and buying a non-income producing asset. Yeah. And that's the thing with crypto, right? You know, income, like crypto doesn't really give you a yield, you know.
No,
hopefully the thing goes up in value, but, you know, you want the thing that you buy to go up in value and provide a yield that you can actually use to pay the debt off. Okay.
Seems simple, but not that simple.
Not that simple. Yeah, I'm sort of understanding it.
Sort of understanding.
I'd say if that's all new to you, I hope that sort of helped shape how it works. I'd encourage you to go and speak to the crew over at Finni Mortgages. You're happy to. You probably explained it 1,000 times.
Yeah. And I think it's also, I guess, a call to people like you said, your family member, just sitting on it, right? So I'm sure people know. The brother, family, aunties, whatever, that just don't realize what they could do.
It's funny when people understand it. It's like you've given them this. You've given them the secret. Like you go,
light bulb moment.
For most people, that's like you want the secret that you don't. The secret in real estate or property investing you don't know about is what you haven't learned about yet.
Yeah, that's right.
So like
I remember when I first found that out. I was like, oh, wow.
So it is a secret, right? But it's a simple secret. But once you know,
you can't find it if you're not looking for it.
Yeah. The key thing is though is that yes, you can keep recycling your debt, but every time you increase your debt, irrespective of where you deploy it, you still have the contingency of having to pay the interest against it. So it's going to impact your serviceability over time. And if you're comfortable make those repayments, or you're comfortable in a negative environment, or you've got your cash flow discipline to be able to manage a negative portfolio until tax, and everyone talks about pre-tax and post-tax type stuff. Like I always think about pre-tax, you know, what does it actually hold? You get the benefits of whatever the tax consequence is. So you need to be responsible for that because the debt is against you. Worst case, if you can't pay it, they'll come and sell your houses.
I don't feel like that's the right way to end the podcast.
Banks don't want to do it, by the
They'll
way.
come after you.
But they will.
They
you know.
will.
But if you
They will.
structure things correctly and do all this and listen to this show, like, you know, banks don't like foreclosing people. Like
No,
that.
of course not.
They hate it. That's why they have these hardship type things.
Yeah,
If you call up a bank, go, I'm really struggling at the moment. This has happened, and you give them a reason.
they
They'll go,
give you a lot of
they'll
time
go,
to fix it up.
I'll give you 3 months as a debt repayment holiday, right? But it's not like they forget about what you haven't paid. They just add it on, and you know, so they, you know, yeah. But they don't. The last thing banks want is for you not to pay your loans, and they've got to sell your properties because there'll be someone out there looking to buy that really cheap ex-property investor. You can't just go. What do you call it? Forgotten bread.
Lost.
Lost
Perdu.
it.
Pas perdu.
Forgotten bread. Forgotten bread's better than lost bread. No, it's probably lost bread.
Yeah.
I'm going to try that. Do you put cheese on it or just sugar?
No, sugar.
Sugar.
Mm.
Oh, I do like it good. Maybe that's why I have for dinner tonight. Thanks,
Think about it. It
Eva.
was like rotten bread, like forgotten in the cabinet somewhere.
I reckon in different various times of in France, they've been pretty good with lost bread.
Yeah.
Lost bread. Do you rate a baker's delight baguette? Is it okay?
Do you have to answer that?
Where, so you only get your stuff. No. Have you got a good bakery near you?
There's a good, I guess, markets where you can find
Like proper.
yeah.
Yeah. Is it still a thing? Like, it's ingrained in all French people to go. It's like we go for bread and milk. You guys
The
go down,
baguettes.
go get a baguette.
Baguette.
to boulangerie.
Yeah, that's not a cliche. The baguette is
It's
sacred.
pretty. It's sacred. I do like it. I do like going to France. It's
Yeah,
one of my
and
favourite
with
countries.
salted butter, has to be salted.
Salted butter. Yeah, it's expensive. You don't use le
That would
pack.
be my last meal if you ask me. Bread and
Like a
sausage.
really salted butter, just butter and a
No,
baguette.
and baguette.
Do you like putting like stuff on top, or is just
No.
no? It's good. I like it anyway.
Anyway,
Thanks for coming in. Maybe you should do a bread and butter night.
bread and butter.
Bread, butter, and finance. Bread, butter, probably. And what do you like with it? A red or
Red,
like
yeah.
a nice Chablis?
Red.
Yeah.
Yeah.
How do people find you, Eva?
Finni.com.au. Very easy. You got a number there, or you can book appointment right away in 20 seconds.
Is that what you like to do? You can go in there and just go, I want to speak to Eva.
Yeah.
And
What time can you speak? What day? Bang, done.
and how do you know you got to call them? You just know. It's in your calendar. It says-
Oh, yeah, don't guess.
Yeah.
It comes in my calendar. And
Do you sit there, go, I'm really, really busy at the moment and I've got to make that. You always make the phone call, always call.
Yeah, like it's literally only the time that we can speak are open. So if it lets you book it, that means we're free at
Okay,
the time.
that's
Yeah.
cool. Very, very good. All right, thanks everyone for tuning in. That's finance for this week on the Smart Property Investment Show. Lots more to come. You can read all about this as well on smartpropertyinvestment.com.au. I hope you're liking what we're doing on social media as well. Remember to like us, follow us, tell your friends. We're trying to build out all our social profiles. And on the podcast stuff, if you like what we're doing, please keep those reviews coming. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.